Welcome back. You're watching Newscentre. India and New Zealand have finalized a free trade agreement with an aim to double bilateral trade in 5 years. Under the deal, 95% of bilateral trade will be exempt from tariffs. The pact is expected to be signed in about 3 months. It will give zero duty access to all of India's exports in New Zealand. Meanwhile, India will offer New Zealand duty-free or reduced duty access on about 70% of its tariff lines. However, dairy, coffee, onions, sugar, spices and edible oils will be kept out of the deal to protect domestic producers. This is India's third deal following a free trade agreement with the UK in July and a comprehensive economic partnership agreement with Oman. Last week, this will also be India's seventh trade agreement since 2021 as the government attempts to diversify the export markets amidst uncertainty over a US trade deal and 50% tariffs. The country has also accelerated its reforms to attract more investments. However, CIO President Rajiv Memani believes India needs a targeted manufacturing strategy that focuses on 50 high import products, including electronics, energy transition, equipment and semiconductors. The industry body recommends that funding for this strategy could come from increased divestment proceeds, with proceeds from selling government stakes in public sector units used to finance infrastructure and competitiveness-enhancing projects. Memani has stressed that such measures would help create jobs, expand manufacturing share of economic output and integrate India more deeply with global supply chains. Joining us right now is Mr. Rajiv Memani himself. He's the president of the Confederation of Indian Industry. Thank you very much for being with us, Mr. Memani. This comes in the backdrop of the India-New Zealand FTA. The talks have been concluded. We are yet to see a timeline for signing of the deal and operationalization of this FTA. But to what extent do you think some of these measures that we have taken to diversify our exports in 2025, how will this help us in mitigating the impact of 50% US tariffs? And what would be your concerns as we head into the new year?
Thanks, Parikshit. So if you actually reflect on this year and the last 12 months, if you have to look at 2 or 3 things that are pretty distinct or that sort of stand out. One is obviously India's overall growth, 8% growth in the last 6 months, and the low, interest rates, moderate inflation. So I think that's on the economic side, especially macroeconomic side, the discipline that the government has maintained has been really very creditable. The second thing is the entire reform agenda, particularly in the last 3 to 6 months. I think that's been very positive. The third, which you mentioned, is the trade diversification strategy that India is pursuing. And I personally think it's very positive. I think from an industry standpoint, as CII, the industry is fully supportive of this strategy and is giving active inputs to the government. And the government is also very actively engaging with the ministry. And trade diversification. If you look at China also, and you look at the China export data, I mean, I think their exports are still growing at a good clip, and you can see a massive shift in their exports away from the US to other countries. Likewise, even if you look at the Indian trade data until now, the exports to US as a percentage of our total exports basket has come down from almost 21% to 16%. So you're already seeing signs of that happening, of trade diversification happening. And I'll tell you one thing that, we've been visiting along with CII delegations, along with the government Ministry of Commerce, various countries where India has signed FTA deals or is in the process of signing FTA deals. FTA is not just about tariff reduction. It's just building a much stronger economic bridge between 2 countries. And the kind of reception, the kind of enthusiasm, the kind of openness, the kind of keenness that all these countries have, is very positive. And as it is, even before the FTA is implemented, you're seeing an increase in the economic activity. So I would say, industry fully supports it. I think it's very positive for the country. These things take time to play, but the initial signs are very, very positive. So I think it's a great way in the current geopolitical environment. I think it's very important that India does these win-win bilateral relationships.
Mr. Memani, I'd also like to ask you about deliberations with the government on the union budget. What do you think is now the major reform that we need, which could catalyze private investments? Now, the pace of private investments has been a concern. What do you think can be done at this stage after the GST reforms, the passing of the insurance bill, the nuclear energy bill, in terms of making it easier to do business? What are you expecting next?
So, Parikshit, maybe let me answer this in two parts. One is, I think there is the general belief that private investments is not happening. At least when we do surveys internally within CII, the research that has been done by CII, and when we look at the CMI data from 2019 onwards till now, the average increase in gross block CAGR is about 15%. This includes the COVID years. Net block is more than 20%. If we look at the number of new projects announced this year versus what happened last year, I think the number is up by 9 to 10%. If we look at number of stalled projects, that's come down. And we look at the data of the listed companies, last reported data for 31st March 25, and compare that with earlier years. There is good growth, almost 20% growth in the gross block, in the block across sectors. So I think one thesis that private investment is not happening is not entirely correct. Yeah, there are periods in which it became slower, particularly when the US tariff deal got delayed. I think some people probably wanted to wait out to see how things happen. But I think people, given the reforms that the government is doing, in particular, I think what has happened with GST reforms and others, I think industry capacity utilizations are up, IPO markets are bullish, balance sheets are strong, and we are seeing at least company after company, so they are announcing that. So that's the first thing I want to say. Secondly, okay. I don't think there's one major reform.
Yeah. If I were to ask you, Mr. Memani, because we're running out of time, would there be 2 or 3 areas where you feel we are likely to get more investments, and maybe one reform that you could leave us with?
No, I won't want to leave with one reform. I think reform is an ongoing process, but I would say the areas where we really need to strengthen in the budget is we have to look at more aggressive numbers on non-tax income, particularly privatization and divestment. I think it's very important that we budget for at least, over a period of next 2 years, a budget for at least 1.5 to 2 lakh crores for that. And I think and then use that money judicially to drive some large projects, whether it is high-speed rails, whether it's utilizing helping states for privatization of distribution companies. Because if we have to become more competitive as the tariff barriers come down, we have to be more competitive. Our factor cost of production has to come down, and I think I think a lot of effort has to be done to reduce the power cost, where there are some inefficiencies, about almost 1.50 rupee to 2 rupee per unit for commercial operations.
Okay.
And I would say in the ease of business, government is doing a lot, Parikshit, but I would say judicial reforms are very, very important. Whether it's the statute of limitations and others, I think those are the things that one has to focus on.
Okay, thank you so much, Mr. Memani, for listing out the reforms and what could drive private capex in fiscal year 27 as well. With that, it's a wrap on this edition of Newscentre. Thanks for watching. Goodbye.